Okay, so I hate this. This does not. Does anybody know better than I do how to zoom this to make it all show up on the screen? No? We'll just fight through it like this if nobody knows better than me. But
I can find out by next week.
Or I can just, just perhaps do it that way. I like it better the other way. Yeah, I don't know if I want to mess with it.
It looks like it's doing okay for the PC, but not for the Mac. You might have.
Oh well.
It might be a 4:3 ratio.
Yeah.
Wider.
That's probably what it is. I don't want to mess with it. So if it becomes an issue, we'll address it. I think most of this stuff is kind of squished into the middle of the screen. I don't think I have too much of my material towards the edges. In addition to what's up here, I've also posted this on Canvas, the slides. So if, as we're going through this, you can't see it well up here, if you want to pull it up on your laptop now as well, that will work too. So most of the actual accounting work that we do and the problems that we work together are going to be just basically a number of journal entries. I don't know how much I talked about the kind of etymology behind accounting. Whoops. But obviously accounting has the root word account. And so it's basically at its root, the actual practice of accounting is just adjusting accounts up and down, right? And so your journal entry, as we've talked about before, is just kind of the basic plus minus unit of adjusting things up and down. Whoops. So I guess as we walk through these, you're basically going to be doing a whole lot of journal entries. As you look at the process of accounting, everything starts with the journal entry, and then the effects of the journal entry, of each journal entry, accumulate within the journal and then get spread out to where they need to be, whether to do financial statements or just to use the information internally. I guess you can't read that very well. You may have to pull it up in front of you if you can't see all of it, but this is the exercise we're going to walk through here. And basically what we have is a list of transactions that happen for this company, Spade Company. And as accountants, what do we want to do? We want to tell the history of what has gone on with Spade Company during this month. And the way that we do that is we do journal entries for each individual transaction or event that occurred. And as we post these journal entries, the effects of all of these events get captured within the journal and then eventually get posted to the ledger. And at the end of the day, once we do adjustments and closing entries, these are all different types of journal entries to adjust the accounts to where they need to be. Then the whole cycle starts back over again. So we'll walk through each of these events and just talk through what the journal entry looks like. And we'll do that for a number of these scenarios. And then we'll also, at least in the group work that we do together, or that you all do together, and then I'll walk through with you at the end. We'll also go from doing the journal entries to posting the effects of that to the individual accounts within the general ledger, to then taking that information and using it to generate the financial statements themselves. So first entry here is Casey Spade, who's the owner, investing $100,750 cash in the company. Remember, I believe I've talked about this. If not, know that one of the, I don't want to say one of the main issues or main concerns, but an issue that a lot of people have, especially at the beginning of their accounting journey, is making sure that they are looking at these events from the proper perspective. So this first one, we see an owner doing something, and people will often have difficulty separating the owner as an individual from the company as an entity. And so what we're doing with these journal entries, that was fast. What we're doing with these journal entries is we're recording the history of financial events that have occurred from the lens of the company, right? So we're not worried about what has gone on or what is going on with Casey Spade, the person right now, the individual. We're worried about what's going on with Spade Company. So when we do this first journal entry, if we were looking at it from Casey's perspective, it would look quite different than looking at it from Spade Company's perspective. So keep in mind when we do these journal entries, every time we record a transaction, which again is just an event that has occurred that we're basically translating into dollars. Okay, an event has occurred that has financial implications. One of the principles of accounting is all such events like that can be changed to dollars. And when you change an event to dollars and want to write it down, this is how we do it. So we need a debit and a credit, at least one of each. The total amounts, dollar amounts of debit and credit for each journal entry have to be equal to each other. Total debits, total credits from each journal entry have to be equal to each other. You also see at the bottom here that we are looking at the kind of an expanded view of the basic accounting equation that lists the normal application of debit and credit balances for the various types of accounts. So as we're doing these, if we see a journal entry that needs to happen, we think, hey, we need to do something to an asset account, I can look down at the bottom of the screen and say, okay, if I want to increase an asset account, is that a debit or a credit? Well, it says down there that normally asset accounts carry that little normal down there. Says the normal balance will be on the debit side, and that is also where increases happen. So this first entry is going to be a debit to cash. Cash is an asset, so we're showing cash increasing here, because from the company's perspective, that's what's happening. Cash increases by $100,750. How did I know it was cash? Well, obviously, that's kind of self-explanatory there. But for most of these, and for the one that I'm going to have you guys do together, you'll have a list of accounts given to you, and you're basically just selecting out which account needs to be selected. Similarly, in actual accounting practice, if you were doing this on a computer, you just have a drop-down list of accounts, and you would select the appropriate one. So obviously, if we're talking about cash coming into the company, then cash is what is affected, or one of the components that's affected here. Again, if we look down here at the basic accounting equation, we said assets or cash was increasing. So something over here on the right side, either a liability or an equity account, either has to increase. So that would be a credit. Looking at both of those two types of accounts, both of those normally carry credit balances. It would either be an increase there, which would be a credit, or it would be a decrease to assets, which would also be a credit. So I know debits and credits are really confusing when you kind of look at them in the abstract, but the whole purpose of debits and credits, the reason that they exist in the way that they do, can be seen as we're doing each of these journal entries by looking down at remembering what needs to happen with the basic accounting equation, and then just analyzing what's actually happening with that, with each of these components. So if you remember what equity is, I said that equity is what's left over when you get rid of, you turn all of your assets into cash, you use those to pay off your liabilities, and whatever the owner has a claim on, whatever they can put in their pocket after all of that's done is equity. So in this case, all we've done so far in this company is add cash to the company's bank account. There are no liabilities yet. So if I was liquidating after this transaction, all of the cash that I put in my bank account could come back into my pocket, right? So it should make sense that the owner's name capital account here is what is going to get this credit here. Because what we're actually saying is, okay, since you put this money in, if I liquidate it as my next step or my next action, then we would just be doing the opposite. You get to take back out your money. So this is just saying, hey, we know what assets are, we know what liabilities are. Anything that's left over once you get rid of those two, or once you get rid of your liabilities with your assets, we'll just call those leftovers, you get to put in your pocket. That's what equity is. So you can see from the owner's perspective here, you can see how it would be confusing if you were thinking from the individual perspective, because as an individual, K Spade just lost $100,000. That money left K Spade's pocket and went into Spade the company's company bank account. Okay? So if you were thinking from the individual perspective, you would think cash is going down, right? Because K Spade's personal cash is going down. But Spade the company's company cash is going up. So remember, always think about perspective. Obviously, if we then took the effect of this journal entry and put it into the appropriate T charts or T accounts, it would just be put $100,750 on the left side of the cash account, same amount right side, K Spade Capital. Everybody with me? Okay. All right, next transaction, company purchased office supplies for $1,250 cash. So, just thinking about what's going on here, we've got a couple of things given to us. We've got office supplies we're talking about. We've got cash we're talking about. These are both two different types of assets. Okay. How do we know it's an asset? Well, an asset is anything that can be turned into cash in the future. So if you think about it, obviously, if you're buying office supplies for cash, they could obviously be returned and get your cash back. This is something of value. It's an asset. How do we show that assets are going up? Come down here to my equation. Look at the normal balance for assets. A debit increases an asset account. So logically, I think, hey, I'm buying supplies. That means supplies are going up. Cash is going down. So as another asset account, you would obviously expect cash to be credited if we are talking about cash going down. So now, again, looking at the effects of that on my T chart, we have done nothing prior to this entry in office supplies, so the only transaction we see in that T chart is this one, a debit for $1,250. Cash, however, has already gotten that debit from the last transaction. We are now showing cash going down. So again, credit, meaning just put that on the right side. So if after this transaction you wanted to know, hey, how much cash do I have? You would take the amount of cash you have on the debit side, subtract the amount of cash you have on the credit side, and that would be your debit balance in the cash account. Okay? Everybody with me on that one? You guys are going to speak up if you're not with me, right? Promise? Everybody put your right arm to the square and swear that you're going to tell me. Okay. Yes.
I'm trying to dumb this down for my non-accounting brain.
Which I think everybody has a non-accounting brain, just so you know. I certainly did. I started with a non-accounting brain too, so don't feel bad.
I'm just trying to get down the facts left and right now.
Mm-hmm.
And I'm not there.
And debit and credit?
Yeah.
Okay.
So, is it fair to say, if you have a investment, a cash investment, you put that on the left?
Well, you have to be more specific. So you say when you have a cash investment, right? So here's how I want you to try to train yourself to think. So we talk about something happening that's some financial event happening. The first thing we think of is, okay, which accounts do I have that this is going to affect? So your example was an investment. So owner is investing in the company. Is that what we're
Yes,
saying?
so
Similar
an
to this.
owner shells
To what we-
out, just this example.
Okay.
Owner
So
shells
the
out.
100,750.
Yep.
Mm-hmm.
That
So
is usually, can you say that it's always going to go on the left if you're putting it in the cash?
yes, that you can say. So
If you're
you can,
journaling it in the cash account, you put it on the left.
if you're increasing it. Okay. So you can
Investment
think.
it would be though, wouldn't it?
Yeah. Well, I want you to get away from using other words. So you don't want to say this is a challenge in accounting. It's taking words that you use in your everyday life and bringing them into accounting where they have kind of exclusive meanings. So I wouldn't say just because you say the word investment that would automatically trigger, or I don't want you to think, hey, good thing means debit or bad thing means debit.
Right.
I want you to get away from that thinking. Debits and credits, I know the definition I gave you was right and left, and that's admittedly oversimplified. What it always is an increase or a decrease. Okay? The reason we don't say that is because you can't think debit always means increase. Because it only always means increase if you're talking about an asset account. Okay? Anything on this side of the basic accounting equation is flipped. It's almost like going to Europe and driving on the other side of the road, right? It's nothing different is happening in what's going on. It's just that we're kind of looking at a mirror image, which should make sense because, again, it's kind of a balancing act, right? So everything over there is kind of the inverse of what's over here. The only exceptions to that rule being that owner withdrawals and expenses, which are technically not even equity accounts, they just affect equity. They don't follow the left-right rule. That's why they're written over here separately, saying these two kind of, in terms of debits and credits, actually function like assets. They follow the rules of the asset side. I'm not going to get into why that is yet, other than just saying that this account, and this account are all temporary accounts that are not actually considered part of this. They do affect that, and that's why they're listed here. That's kind of as far as I want to push that component right now. But if you can make yourself remember that debit and credit will always mean increase or decrease, and I wouldn't even mess with, I would just train your mind to remember on these three occasions, if you're dealing with revenues, withdrawals, expenses, just knowing what those three individual accounts are. Revenues follows the normal rule where credits increase it, debits decrease it, expenses are flip-flopped. So there's three exceptions. Everything else follows the rules that we're talking about. So if you can just commit the basic general rule to your mind and not so much worry about the exceptions, those are items that you can just look up at a different time, whenever you're using them. So if you just commit to memory the basic idea that if you're dealing with anything over here, debit means increase. Anything over here, debit means decrease. So at the outset, whenever you look, you see a line that says, hey, this happened. The company purchased office supplies for cash. Step one, figure out which accounts are involved. Okay? Once you figure out which accounts are involved, you can say, okay, in this scenario, well, I have it listed, obviously, but if I didn't, most of the time you get a basic, even you guys with limited accounting knowledge, if you were given 15 accounts, you'd probably get pretty close to the right ones just by process of elimination, right? And as your accounting knowledge grows, obviously that will get more and more easy to discern. So in this case, we already know it's office supplies and cash. But in any scenario, if I looked at that and figured out first, okay, I've got office supplies and cash. Am I increasing office supplies or decreasing them?
Increase.
Well, I'm buying them, so I'm increasing them, right? And you can reason through, okay, I'm buying something, so is cash going up or down? So once you have the two accounts, you can determine in your head which one's up, which one's down. Once you have that, then is when I would come down and determine which is a debit and a credit. Okay? So first, I think that's the easiest way to reason through it. Look at what's going on, see if you can figure out which two, or there might be more than two accounts, because there could be one debit and three credits to balance, right? So to figure out which accounts are involved, usually that's either going to be, well, for you guys' purposes as non-accountants in a class, that's always just going to be given to you. As an accountant, it's a non-issue as well. It's not something you would worry about. Once you have that down, if you can figure out up and down, and you even just have this chart in front of you, you can just say, okay, I know I've got office supplies, I've got cash. If I don't know those are asset accounts, I can look up, are these asset accounts or what types of accounts are these? And then once I have that knowledge, I just need this chart to be able to tell me which is up, which is down. Does that help at all?
It does, especially on like the expenses part. I'm still not quite on the the cash invested in the business. I'm
Okay.
Still stuck
So
on the first part.
Okay.
of this
You're
part.
stuck on cash going up, or which part? Determining which accounts are involved in that?
Where it goes on the chart. If it's up or down.
Okay, so
Where,
let me
because
back up
I'm
to-
thinking of it coming out of my pocket, like you just said, I can't go away from that.
okay, well again, you got to think perspective, right? Think perspective. So put yourself in Case Spade's shoes here. You're Case Spade, right? Cash is coming out of your pocket, yes. Cash is not coming out of the business. So the business's cash account, which is the one we're talking about here, is that going up or down? Up, right? So would that be a debit or a credit? Right. Okay. And then capital, remember, think of capital as an owner, whatever's left over that I get to keep at the end of the day. So does the leftover that I get to keep go up or down in this transaction?
Leftover goes up.
Obviously it goes down, but I don't know what I
Well, no, it actually goes
Goes
up,
up.
right? So I know I'm putting you on the spot. It's hard to think when you're on the spot. So I'm not trying to quiz you here. I'm just trying to help you through this. But I'm trying to think of a better way to explain that. It's hard to think of equity. It's
If you
equity.
put the money in the business, that's the capital goes up.
Yeah, capital goes up. Okay, so you're with me there.
Yeah.
So with that in mind, owner investments over here is really the only true equity account that we have over here. All these other three that we talked about were those exceptions that we're talking about. So owner's capital is the same as what you see for liabilities. It just follows the normal rule. So like you said, capital goes up when you put money into the business. So an increase in capital means a credit. Okay? Does that help at all? Okay. I mean, like I said, I'm being totally honest when I say this. I worked as a CFO for almost 5 years before I went into academia. Honestly, did not understand accounting 100% well until I started teaching it. Okay? Post CPA, post years and years and years. So don't feel bad. I mean, it takes repetition, repetition, repetition. And you guys will never get there if you're not. I mean, you guys aren't accountants. None of you want to be accountants, right? I wish I had a picture of you guys' face when I said that. I won't take offense to that. No, I highly recommend accounting as a profitable career. I say nothing about the other sides of the career. Okay, so you are with me at this point. As we go through these, it will get more and more clear as with each one we go. Okay, we did office supplies already. All right, next one. Company purchases $10,050 of office equipment on credit. So again, first step, try to figure out the accounts that we might be dealing with here. Well, if we're buying office equipment, that sounds a lot like a type of asset to me, right? Because it's something of value. If I had to liquidate it, turn it into cash in the future, that is something that I could do. So I've got an asset account that I'm increasing, right? Because I'm adding office equipment to this account. So, you know, obviously, we talked about one of the basic principles of accounting is the cost principle, where the amount that we put in these asset accounts when we buy something is just whatever we purchased the item for, basically, historical cost. So the amount that we're going to increase this asset account, this office equipment account, by is $10,000 or $10,050. On the other side, since it says on credit, we're not paying cash, and so on credit means it's going to be some type of liability, right? Liabilities typically have the word payable in them. The standard liability account that's kind of a catch-all that most companies use will be accounts payable for these types of kind of generic transactions. So we are essentially recording an asset account, office equipment going up by that amount with a debit. We move over to a liability account, accounts payable also going up because we want to show, again, that we as a company owe something to someone else. That's what gets captured in these liability accounts. This is another area that sometimes causes people difficulty because you think liability and you think negative. This is a bad thing, right? This is affecting the company in a negative way. But that doesn't mean that when you increase your accounts payable that you're decreasing liabilities. A lot of people want to say, oh, this is negative, I should decrease something, right? And so they end up accidentally putting it down as a debit because they're thinking, well, how do I decrease liabilities? I put it in as a debit. You have to remember that in terms of, even though it's a bad thing, or a negative thing, I should say, increasing it is how you show that your balance in that account has gone up, that you owe that much to someone else. Okay? Anybody have any questions on that one? Again, neither of these accounts have been touched yet, so putting the effects of the journal entry into the ledger is pretty easy. We're just copying over debits to debits, credits to credits. Okay, and obviously these are oversimplified. Most real companies are going to have like Valley Health, for instance. Who knows how many? None of you guys work in collections for Valley Health, no. Who knows how many accounts payable and accounts receivable? Probably a ridiculous number here within this system. Let's see. So yeah, I mean, when we look at these, even like cash is typically the account that gets hit the most. I think in our examples, we may have like 8 or 10 at the most transactions that involve cash. Whereas when I worked for a municipality, our cash account would have I don't know, something like maybe 15,000 transactions per month in it. So you're talking about a very long T-chart if I was going to pull that all out. So, I mean, this obviously, with computers, it's not a huge deal, but if you think back to the days when this was being written down on paper, you're talking about a lot of work in doing the transfer from the journal entry itself to the the big 3-ring binder that houses all of these different accounts and everything that's happened within those, which is what we call the ledger. Okay, company received $15,500 cash as fees for services provided to a customer. So again, what are we looking at here? We need to figure out which 2 accounts are going to be affected. In this case, there's only 2. I shouldn't keep saying 2 because there will be times that it's more than 2 accounts. In this case, obviously, anytime you see the word cash, you can assume the cash account is going to be affected somehow. So we've got, again, an increase. This is us doing whatever we do for our business. So that's revenue. So we are increasing the cash to the company by generating revenue through the provision of services to customers. Excuse me. So the revenue account title, these are going to vary depending on what company you work for or are working with. Could be fees earned. It could be just called earned revenue. It could be called, if you're talking about a merchandiser, it could be called sales. It could be called sales revenue. Bottom line is, if you see something that looks like that, that conveys the message that this is the revenue for your company. This is you earning money doing what it is that you do for a living, what your company does. So that, again, is going to be where we run into having, well, this particular one still functions like the rules for equity, but remember, revenue is not actually an equity account, but in this case still follows the rules. So we want to show that earned revenue has gone up, so we follow the revenue rule. To increase revenue, we will credit it. And let me just talk to that real quick. We'll get into this more later, but I said it, so I want to explain a little bit why these three temporary accounts even show up here, why we talk about them here, why we confuse you with them here. These two, revenues minus expenses, are what goes into the income statement. That's all you see on the income statement. And so these three actually are all what we call temporary accounts. And eventually what's going to happen to all three of these accounts is at the end of the year, the effects of all three of these will be captured within the owner's capital account. Okay? But we keep track of revenues and expenses separately during the year because there's a lot of financial ratios that look at net income and some various other components of expenses and revenues to analyze how a company's doing. And, you know, probably the most important financial statement we talk about in terms of how a company's doing in terms of their actual business for this current year is the income statement, okay? But, so having revenues and expenses tracked separately for a little while makes sense because we use that information to generate the income statement, which is valuable information to investors. But at the end of the day, all of that information will reset to 0 each year. Every time you do financial statements, those numbers reset to 0 within the temporary accounts. Okay? The effects of those, however, eventually do get captured within a permanent equity account. And if you look at that, where they're getting captured in the permanent equity account, that equity account follows this rule. Okay, that owner's withdrawal account follows this, increases with the credit, decreases with the debit. And so the permanent effects of these three accounts do follow that rule. But during the year, as you're keeping track of revenues and expenses, they're just kind of housed in a temporary location for a little while. I know that's a little bit confusing for right now. You can get by just thinking about, okay, I don't want to worry about the exceptions. I'm just going to think about the general rule. That will get you pretty far. And then, let's see, probably next week's exercises will actually run through the adjustments and the closing entries so we can see the process of changing those temporary accounts over to permanent effects. Okay, so any questions on the cash fees earned component of this?
I have a dumb question.
Yes. There's no such thing as a dumb question, though.
It's okay if they both increase.
Mm-hmm.
Yeah.
Because remember,
Get the match on both sides.
yeah.
Wait.
Remember,
But
if
they're
you
both
do
increasing.
if you do something to this side of the equation, hey, no laughing, no laughing.
I'm laughing with it.
Yes, okay, that's fair. As long as you disclose that at the outset.
Yeah.
No, just remember back to algebra, to math class, right? If this side goes up, that side must also go up. Okay? So when you're talking back to originally what we said, analyze which two accounts are affected, right? For each event. When you figure out which two accounts are affected, say, are they going up or are they going down? After that, you just have to figure out which side they're on, and you know that's a debit or that's a credit. Okay? So you will have any combination. Well, I mean, you're always going to have either increase plus increase if it's something from this side and something from that side, or increase plus decrease if it's all on one side of the basic accounting equation. Okay? Because otherwise you'd be out of balance, and that you'd be breaking cardinal rule number 1. Okay. And you can see as we go, whoops, you can see as we go, cash is starting to fill out a little bit there. And for most entities, obviously cash is what gets hit the most times. And that also kind of explains at least a little bit of why we do a statement of cash flows. Yes, ma'am?
So on this slide, if you just go back one, my confusion is why the 100,750 keeps jumping around. I can't, so from the first page to the second page, it moved from being, is it because it's the remaining balance?
Well, tell me where you're seeing it move.
So I'm sorry.
No, you're fine.
At the beginning,
I can back up here.
It was under capital, so it was on the right
Okay.
side of the equation.
Well, it was both places, right?
Yeah.
Let's go back to that one real quick. Right here.
Yes.
See? So remember, always got to look at which account we're talking about. So if you're looking at that amount in the cash account, it always stayed on the left side. It's also on the right side of the capital account because in our journal entry, the credit was to the capital side, right? So that's, again, don't feel dumb or alone when you're thinking this. That's one of the tricks with the double entry accounting is that the same numbers will always show up twice. So it can get really confusing, especially when if you are asked, like I'm asking you guys to do today, to actually post the numbers from the journal to an actual ledger yourself and not just do it on a computer. If you're asked to do that and you have double sets of numbers for everything, it gets very easy to transpose and do what you just did, where you're like, well, I thought I saw that number on the right side before, or whatever. So again,
this slide to the next one it's because on the next slide then there isn't a capital account, there's only a capital.
Yeah. So the capital account disappears, and then, but only because in the transactions we do after this one, there's no other journal entries we've done yet that also hit that capital account. Okay.
I think the biggest confusing thing is, do you ever have anything that shows a cumulative, like you have all these different T accounts,
Mm-hmm.
and depending on how many accounts you have, you may have 20 different T accounts.
Mm-hmm.
Is there anything that pulls it all together and says, okay, here's a list of all your assets, here's a list of all your liabilities, and here's a list of all your equity?
There is.
Okay.
It's called the balance sheet.
Is there anything that shows
The process of getting there, is that what you mean, or what?
Like I see, like working through this, I see a bunch of different T accounts.
Right.
Now I'm scroll ahead and see what's at the end, but does it show a balance at the
Oh,
end?
yeah. So what we walked through as a class together, that problem, and I'll walk through the solution to that as well. But yeah, that will show getting to the balance sheet. But really, you're just saying, well, how do I get from having a bunch of T-charts to relevant information? Is that what you're getting at? So in practicality, in real life, what you do is you push a button and it shoots it to the. If you've correctly done all your journal entries as a real life accountant, that's pretty much what they do. I mean, when I worked in government, most of what I did at my computer was entering journal entries. And then when it came time to do financial statements, well, yeah, there are some extra journal entries you do to make adjustments and to tweak here and there. But really, all of that legwork is the journal entries, and then you push a button and it all appears where you want it to
It
appear.
does. I mean, you don't have to do any of this.
Yeah.
Mine, I just put in
Yeah.
the numbers and it does it for me.
Yes. But the problem is, I used to teach high school math, and when I went through high school, you couldn't use a calculator until you learned it. And then I was just at the age where like graphing calculators were getting big and stuff. And so when I taught math in high school, they had no idea how to do any of the problems without a calculator. And I taught high school, and apparently going up through elementary school at that point, they had used calculators all the way through. They had no idea how to do any of the math without a calculator. So that's a problem. There is a reason that you're supposed to know how to do this stuff without that, because the issue is if anything happens where it doesn't print out exactly the way it's supposed to, you're screwed if you don't know what's going on behind the scenes.
So if you're doing this on paper, you would have, say you have like a simple business that has like 10 asset accounts with a cheat sheet for each one.
Mm-hmm.
You would go to the debits and credits and sort of reconcile all those,
Yeah.
and then you would have a credit balance for one asset account.
Yeah.
And then you would aggregate all the asset accounts, and then that would give you your total debit or credit.
So you would, just like you described, you'd have all these T-charts. The next step in the process, if you're doing it on paper, would be a trial balance, which is like you said, pull out the account name and just the balance. Debit or credit, and tell me what the balance is. Those total down to a total of debits and credits, and those should equal. Okay, you should have equal debits and credits. From the trial balance, you do some adjusting entries, which we'll talk about later, to get everything correct. And then all the information's there and ready to go to financial statements. Really, if you look at the financial statements, all they are is like if you look at the balance sheet, it just lists out essentially what's in the trial balance. It lists out all your asset accounts in a special order, following a template. But it lists out all your asset accounts, it lists out all your liability accounts, all your equity accounts, and, shows that they balance. Okay? Income statement, all it does is lists out all your revenue accounts, all your expense accounts, and says revenue minus expense, this is either your net income or your net loss. Okay, so basically the financial statements, all they are, and the reason that a computer can just push the button and it goes everywhere, is the financial statement is just sucking information from your journals to populate in the right spots. Okay, everybody with me there? All right. Okay. Forgot how far we were, though. E, you said? Did that answer whoever's question? I'm sorry, yeah? Okay.
One more quick question.
Yeah.
A T account doesn't necessarily have to balance the credits and debits for a particular period.
And it wouldn't unless the balance was zero.
Okay.
Okay, yeah. So yeah, for the accounts I'm talking about that are temporary, that you're going to reset to zero, the way that you reset accounts to zero is like you just said. You balance them so that the debits equal the credits. But yeah, if you have any balance in the account, it should not balance. Okay. So we recorded in a previous entry that we bought that office equipment with an account payable, meaning that we owed someone money, right? As long as we owed that money, we had a liability sitting on our account. Now we're going to go pay that liability off. So if you look at the liabilities, we want our liabilities that we have on our account to go down. A debit will do that. So we take accounts payable, we debit it by $10,050. And then obviously I'm sorry, I should have started out with this. Two accounts in question here would be cash and accounts payable. And obviously anytime, like I said before, you see the word cash, you know that one is going to get hit. Everybody understand how this one worked? So if you... Is this what you were going to ask about?
Maybe.
So if you look at accounts payable now, in the T-chart, if you've paid off all of the accounts payable, it should balance to zero, right? If it doesn't balance to zero, someone looks at your accounts, they see that you owe someone money. So if you don't owe someone money, the account should balance to zero. And any positive balance in the account represents money that you owe to someone else. That's why you see under liabilities, well, why does it normally carry a credit balance? Well, it's kind of hard to have negative liabilities. And when we do, we don't actually call it that, right? We don't have negative money we owe someone else. They owe us money. So pretty much for the liability account, if you ever have a negative balance in the liability account, something probably went wrong. Okay. Did that answer your question?
Increased credits in liability with the cash.
Wait, say that again.
You increased credits in the liability feature with cash,
Okay.
and the accounts payable.
Well, let me stop you for a second here. I don't want you to use, because you're kind of using cash as a verb there, almost.
Okay.
Not really a verb, but you're saying you're using, I'm not really increasing it with the cash. I'm using cash to increase the account. I know I'm splitting hairs on the words you're using here, but you are paying cash, so you're spending cash to lower your liabilities. So if you look at the effect of the basic accounting equation in the company's eyes, your company's cash is going down, so the left side is going down, but also the amount they owe is going down. Right? I'm sorry, I pointed to increase, but I meant debits here, decrease.
Okay.
Sorry, I'm confusing you as I
Yeah,
explain.
you're confused. I'm confused.
Do as I say, not as I should. No. Yeah, so after I confused you, did I?
Go through it one more time, please.
Can you hit the button so we see the...
Yeah, sorry.
Okay, that makes more sense.
Okay, I didn't even notice that I hadn't done that yet, sorry. So I'm using cash, so from the company's perspective, I look at which accounts are affected. Well, I've got my liability account, accounts payable, is affected. I want to show that that's going away. Okay, and my cash is going down as well, because I have to pay it. I'm using it. So I have two accounts, accounts payable and cash, both going down, because if you think about what the liability account shows, it shows how much money I owe. So if I want what I owe to go down, I decrease that account. Okay, so that's a debit here. And I know that cash is an asset, and if cash is going away, that means it's decreasing, so I have a credit to cash.
Okay.
You with me? Okay, everybody? Good. Okay. Company billed a customer $2,700 as fees for services provided. Very similar to one we did already. Difference being that now instead of getting cash, we have a different asset account we're using. This is where we store all of our money that someone else owes to us. Anytime we have a receivable, that means someone owes us some type of asset in the future. So this is an asset to us. It will turn into cash in the future, and if I had to, I could sell it for cash right now. Okay. So obviously, if I want to increase this asset account, accounts receivable, I will debit it. And again, showing the fees earned for this particular company is going to be my revenue account, showing this is what I do for a living, providing services for customers. So I have a credit to that revenue account. Everybody with me?
So accounts payable are always equity, but what accounts? So money that hasn't been paid yet's a liability.
Money that, from the company's perspective, that you owe to another entity is always a liability. And not just money, anything of value that you owe to someone else. So, for instance, not to confuse you, but if someone gives you money ahead of time for services that you haven't performed yet, unearned revenue, you're not probably planning to give them money back, but you are going to give them services. That is considered a liability because you owe something of value to someone else in the future. Okay, so both of those, I guess fees earned is getting its second entry here, but everything there should be pretty easily explainable. Any questions so far on that one? All right, company paid $1,225 cash for monthly rent. So this is going to be an example of an expense. If you look over there under equity, again, expenses are not technically equity accounts, but the effects of them show up under equity. But if you look at expenses, the rule there says that, well, actually that doesn't really show terribly well what it means. But the fact that owner's withdrawals and expenses are on the left side over here basically just means treat them like you would asset accounts. So these both carry debit balances and are increased with debits. So we've got a debit to rent expense for $1,225. Again, cash would show up, or cash shows up in the event listing there, so we obviously have to hit the cash account. Going back to my comment on knowing which accounts to hit, if you guys had a drop-down window and you're trying to figure out, well, I'm paying monthly rent, what account should be affected, you would probably all stop at rent expense and figure this is probably the right account. Okay, so expense accounts pretty much always have the word expense in them, so they're pretty easy to recognize. But generally will represent costs associated with earning revenue. Okay, costs associated with earning revenue. Again, for the T-charts, rent expense hit for the first time, and we can see our sixth entry under the cash account. So now we have collected some cash on the account receivable that we already recorded. So that's obvious which two accounts we're talking about here. We've got cash and we've got accounts receivable. Cash is going up, it's an asset, so we will debit that asset account to show that it is increasing. And we have another asset account, accounts receivable, that is going down, right? Accounts receivable shows what other people owe us. So if we want to remove the fact that someone else owes us money, we're going to decrease the balance in accounts receivable. So anytime we have a balance in accounts receivable, it means someone owes us money. Anytime we have a balance in accounts payable, it means we owe somebody else money. So under accounts receivable, anyone who after this entry wanted to know, well, hey, I wonder how much we're still owed on that account receivable. Again, subtract 1,125 from 2,700. The balance obviously is weighed more heavily on the debit side, and so whatever the difference between those would be, what is that, 1,575? Yeah. So that would be a debit balance of 1,575 there. Okay, so again, anytime, and I really want you guys to pay attention to this, anytime you have a transaction that involves the owner themselves, make sure you think to yourself, hey, is this going to be, think to yourself, focus on perspective, right? Make sure that you're looking at this through the lens of the company itself and not through the individual's lens. So what's happening from the company's perspective? Cash is leaving the company's bank account and going into individual Spade's pocket. So cash is going down. Again, if you had to pick from a drop-down menu, you probably pretty easily select Spade withdrawals if you were given that information and said, hey, go find where this withdrawal should come out of. And the only reason I keep bringing that up is I know a lot of people have nerves or just get kind of frustrated about not knowing which accounts to hit. But I keep touching on that because it really is not a huge deal. Most of the accounts are pretty self-explanatory. Again, withdrawals, like I said before, is an exception over there. It's a temporary account, so it kind of follows the rules of the asset accounts in terms of debits and credits. So if I want to increase the amount that looking at K-Spade withdrawals, what is in that account, what does that tell me? That tells me this is how much the owner has taken out of the business and put in his or her own pocket. Okay? So from that perspective, if you're increasing what's in K-Spade withdrawals account, that is increasing the amount that's coming out. Now that might be a little confusing too. So from the company's perspective, cash is leaving the company's coffers, and we are recording the fact that K-Spade is the reason that that cash is leaving. The owner now there are less leftovers available for the owner to put in his or her pocket if we have to liquidate tomorrow. I'm sorry, I keep doing that with the final part of that going on the T-chart. Okay, so the next step would be looking at all of these and making sure all of these are in the T-charts. This would be what would be considered posting to the ledger. So on the question that I have for you guys to do together, it says, hey, first do these journal entries. Once you've done the journal entries, make a T-chart for each account like this and transfer the effects of each journal entry over to the T-charts. Now, obviously, as I was doing these, we were filling that in as I went. That's probably the easiest way to do it. But the way it reads in the actual question says, do the journal entries first. Once the journal entries are done, then come over and fill in the T-charts. Once you fill in the T-charts, to then go to the next step, which is to generate the trial balance, obviously the accounts that only have one entry in them, like pretty much all of them except for cash and fees earned and accounts payable, or I guess and accounts receivable. If it has one entry, obviously you don't have to total it. If it has more than one entry, total up the debits, total up the credits, figure out the difference, and put whichever side is more, put the difference on that side. So this tells me there's 94,850 more debits than there are credits here. And I would go through and do that for each one. Once I had my balance for each account, the trial balance would mean a line item for each one of these accounts that just said the account's name and either credit this amount or debit this amount. And that's all the trial balance is. Okay? It's kind of split up here, but this is not rocket science of essentially recopying account titles and putting the balance in the correct column. Okay, so I know this is hard to look at over here, but pretty easy. Account title, look at the bottom. Once you've done all of this, make sure debits, credits equal each other. If they don't equal each other, and I should speak to this a little bit, the whole purpose of a trial balance, or one of the purposes, is to check your work. Okay? Back in the day, this was a lot more important than it is now, but is still widely used in the accounting profession. You can imagine if you have or just think of Valley Health, for instance. Who knows how many transactions go on at Valley Health every day, right? If there was an actual person, or obviously that would be more than one person, who had to write down every financial event that occurred with Valley Health each day, and then at the end of the day, had to come over and take the effects of those journal entries and put them into T-charts by hand. And then at the end of the month, or whenever we wanted to do a trial balance, had to go through and calculate the balance in each one of those accounts and put it on a piece of paper and total those all up. You can see how there's infinitely many possibilities of where you could drop a number, transcribe it wrong, screw something up somewhere. So back in the day, the trial balance was just, hey, we don't want to do any more work. We don't want to screw this up anymore until we're sure, or at least have some measure of surety that we didn't do any of that. We didn't transpose a number. We didn't drop a number. Everything we pulled over is in the right spot. Okay, nowadays with computer system, most of them don't let you do a journal entry that's out of balance. If you try to do one that doesn't follow the basic rules or that puts you out of balance, it will pop up an error, and you basically would have to try really hard to let you do that. Okay? So nowadays, a trial balance is not nearly as important as it used to be. We still do them at every kind of major junction point before we're going to go and do a lot more entries or adjustments or closing entries, just so we can say, hey, let me double check, make sure that all of these are copacetic and look the way that they should. Also, the trial balance, once we've done all the adjustments, then the trial balance is what we use to get the information to then go put it into the financial statements. Okay.
To simplify this,
Be my guest.
if we have assets equal liabilities and equity,
Mm-hmm.
so under the assets would be cash and office supplies.
For this
For this
particular,
one.
yeah. Mm-hmm.
For liabilities, we would have accounts payable and accounts receivable.
Well, I'm sorry. Accounts receivable is actually an asset as well. So that actually should be, and I got screwed up there because the tradition for listing accounts out is you would typically list them out the way that they would show up in a balance sheet, which I'm guessing is where you're going with this.
Right.
Okay. So typically when you see a bunch of accounts listed out there, they will automatically put them in order of, we'll put assets first, liabilities second, equities last, just so it's easier to look at from that perspective. But if that's where you're going from this, yes. We look at this, we say, okay, balance sheet-wise, we've got asset accounts like you listed. We've got cash, we've got office supplies, we've got accounts receivable. Liabilities-wise, we've got accounts payable, okay? And then the only, well, actually, I'm sorry, I forgot to add office equipment. So assets include cash, office equipment, office supplies, and accounts receivable. Liabilities, just accounts payable. And the only actual equity account we have is K-Spade Capital. Then we have a revenue account, an expense account, and this temporary account that this one actually doesn't go on any financial statement, but the effect of that will eventually show up in that capital account.
But all those would be under equity, though.
So yeah, all of these, so if you went to do financial statements, these two, obviously oversimplified, but these two would be the only thing that made up your income statement. You have fees earned minus, obviously this is unrealistic, but minus rent expense as your only expense. And so your net income would be 18,200 minus 1,225. Your income statement would be two lines. Fees earned was this amount, total revenues this amount, rent expense was this amount, total expenses this amount, and net income, the difference. Okay? So you can see, wow, all of this stuff, I mean, it's all pulling from basically just tweaking individual accounts. So, you know, it's appropriately named discipline of accounting. And, you know, I don't know if explaining it that way is simplifying it or not, but yeah, once you get to this point, now at this point, we've not covered adjusting entries, which I'll talk about what that is next week, or closing entries. So the adjusting entries would be done before we did the financial statements. But the basic information, I mean, the numbers would change slightly, but the basic information you need to do all of the financial statements you have for this limited, simplified scenario. So I guess the trick to, well, it doesn't get a whole lot more complex than that. There are nuances to it. And as you know, obviously doing 10 transactions is different than doing 10,000 transactions. So simplifying it to only doing a few transactions makes things a lot easier to deal with. But the principle doesn't change if you're doing it for 1 million transactions. It's just drudgery, lots of drudgery.
With the software and stuff that you have, would you still look at a key account like that?
Generally not. So generally what you would do, in fact, I'm trying to think back to when I was in city government, if you could even, I don't remember there even being a way to look at it as a T-chart. But generally the way that you would see these would be well, the format would actually look a lot like this. So you would have account name, and then each transaction, and it would either be a debit or a credit. So as far as if you just looked at this part of it, it would look like a T-chart. Everybody comfortable with that? Okay. All right, y'all's turn. So why don't we take a 10-minute break? We'll come back and we'll bang this out, and that's after I explain this, that will be done for the day after this. So let's come back here at, well, let's just do 6 minutes. Let's do 7:15. Pick back up.
I mean, stop that time.
I put that up just to screw with you guys.
Yeah.